Welcome again, options traders. Happy Wednesday to everyone. And I received an email from one of the traders in our group, and he was asking if there is a formula or a way that you could easily figure out by how much your options price is going to move in terms of percentages for a $1 change in the stock's price. And I just clarified and I said, well, are we talking about a $1 move always or a 1% move? And I think he was thinking that he was using a $100 stock, and therefore a $1 change would be the same as 1%. Then he realized, well, what if we're talking about a $500 stock? Those are two very different things. And that's why we need different formulas to solve this. So let me show you the different techniques you can use. And I've talked about them in previous videos, but I'm going to kind of roll them all into one video here. But if the formulas confuse you, don't really worry so much about that, as much as to understand that when things change in the market, such as the stock price, the volatility, time to expiration, everything changes. And that's why these formulas are going to have to always be updated. Pretty much every time the stock price makes some kind of a relatively small move, you're going to have to go through these calculations again. So just realize that just as if you have a 50 delta, you can't say that you always have a 50 delta. And if you come up with a calculation that says you're going to make 25% on that next dollar move, it's not always going to be that. It's always going to change. So let's go find out. If the stock moves $1 versus 1%, what percent will your options price move? Let's go find out. And as always, before we do, please be sure to click like and subscribe. It's greatly appreciated and helps to promote the channel. So quick little refresher. Remember, we've talked about this before, but for people who might be new, we need to talk about delta. It's going to show up in our calculations. And what delta does, it shows the change in your options price for a small change in the stock's price. Now, your delta for calls is going to be between 0 and 1, and technically 0 and minus 1 for puts. Now, we said that it has to be a small change. And if you talk to most traders, that usually means a $1 move. But that's actually technically too big. So just realize that when we use a $1 change in our formulas here, we're going to be off a little bit. Probably not enough to worry about, but that's why it's not going to come out exact. So we're going to look at a $1 change and a 1% change. Let's start off with a $1 change. So remember, this might be 1% if it's a $100 stock. If it's a $500 stock, it's a 0.2% change. So it's not always going to be the same percent. We're assuming that we're just moving the stock by $1, and we're trying to figure out by how much our options price is going to change in terms of percentages. So for a $1 change, let's say that our stock is 100, we have 30 days to expiration, volatility 20%, and our broker's platform says that the delta is 0.51. Now these are from a pricing model. And so now let's say that the stock rises $1 from $100 to 101. The pricing model shows that that $100 call rises from 229 to 283. And so if we want to find out what this percentage change is going to be, it should be fairly obvious. Our option is going to pick up delta. It's currently worth 229, but because it has a delta of 51, it means it's going to pick up 51 cents of that next dollar move. So if the stock rises $1, our call should pick up 51 cents, which should be $2.80. But if you put it into a pricing model, you'll see it goes to 283. So we're off by a little bit, by 3 cents. Why? Because of gamma. And that's why I said that a $1 move is technically too big. But again, for practical purposes, we're certainly good enough. So to find the percentage change is actually very easy. Just take the delta divided by your options price. So we would just take 0.51 divided by 229. So again, if we're into a pricing model and it shows that our option is going to move from 229 to 283, this is what we're trying to predict. Well, that's pretty easy. We're saying it's going from 229 to 283. We take 283 divided by 229, subtract off 1 and multiply by 100. And that's going to give us 23.6%. This is the number that we'd really like to know. But remember, we're going to be off a little bit, because if we take delta divided by 229, it's not going to be exactly right because of gamma. But let's just do it, see what we get. Let's take 0.51 divided by 229, and we get 22.3. So as expected, we are off a little bit, but for practical purposes, it's probably pretty good. Now, if you want it to be a little better, we'll do another calculation here in a moment. But this is going to be your simplest. Just take delta, the current delta, divided by the current options price. And that's what you would expect that options price to be trading for, assuming that it's a $1 change in the stock and that it's relatively quick. We're not doing this a week or a month later when a lot of time decay is kicked in, or when volatility has changed. It's assuming all else constant. So what would happen if we used an in-the-money option? Well, the same pricing model shows that, let's say, the $95 call with the stock at 100 is worth $5.57 and a delta of 82. If we go into the pricing model and change the stock to 101, it tells us that the $95 call rises to $6.41. So as before, these are the two prices that we would get. This is what we're trying to figure out. Now, of course, we don't know that unless we go to a pricing model. All we know is that the current options price is $5.57, and we know our current delta is 82. But you can see, as with the previous example, if we take $5.57 plus 82, we get $6.39. And yet the actual answer is $6.41. We're off by a few pennies. Why? Because of gamma. But again, probably not enough to worry about. But if we take $6.41 divided by the $5.57 current price, subtract off 1, multiply by 100, that's a 15.1% increase. So you can see that once that option goes in the money, the percentage changes are going to start dropping. But what would our simple formula tell us? Well, we're going to take 82 delta divided by the current option price of $5.57, and that tells us 14.7%. Not too far off of 15.1, but not dead on accurate either. Why? Because of gamma. Gamma has increased our options price a little bit more than delta would project, and that's why our percentage is a little bit off. Now, what if we go to an out-of-the-money option? Let's say that we have a 105 call trading for 64 cents, and our delta is 21. So if we go to a pricing model, we change the stock price from 100 to 101, it's going to tell us that that 105 call would be trading for 88 cents. So that's 24 cents higher. Again, a little bit higher than delta projected. But again, not too far off. So what's the percentage change? Well, in a pricing model, we know it's going to rise from 64 cents to 88 cents on that next dollar move. And if we do our percent change calculation, it's 37.5%. But what does our simple formula tell us? Take the delta of 21 divided by the current call price of 64 cents, and we get 32.8%. See, now we're starting to see a bigger discrepancy, and partly because we're now coming up into that gamma curve, into the accelerated portion as opposed to the decelerated portion once we're in the money. So our percentages are going to be a little bit more off. But again, if you're just trying to find a rough approximation, it's certainly not bad to just take delta divided by your current call price. Use that as your projected new options price, and then just divide that by your current options price. All right, so that's a kind of a rough rule of thumb way, very quick. A lot of times you can almost do it in your head to figure out by how much your options price is going to move in percentage terms for the next $1 move in the stock. But what if you wanted a better approximation? Well, if you want a better approximation, it's going to come at a cost. It's going to be a little bit more work. And here we need to use delta and gamma. Okay, so we previously talked about delta. Remember that it shows the change in your options price for a small change in the stock's price. But gamma shows the rate of change of delta. And that's why it's sometimes called the delta of the delta. So if we know gamma, you can add gamma divided by 2 to your delta, and that will give you a better approximation for your delta. Now, this approximation also works for larger stock price changes, not just for the next $1 move. You still can't go crazy with it, but if you did a $2 or $3, maybe even a $4 move in the stock's price, this is where you definitely want to start adding this term of gamma over 2. Now, I've talked about this in a previous video. If you do want to use a stock price change larger than $1, you need to multiply the square of that stock price change. So if you're looking for a $3 move in the stock price, 3 squared is 9. You would have to take gamma divided by 2 multiplied by 9, and then you would have to also add that to, in this case, 3 times your stock price times the delta. But if you're only trying to figure out for a $1 move, it's very simple. Just take gamma divided by 2 and add it to delta. So let's go back to the information that we had before. Stock is 100. We've got a delta of 0.51. But now we look at our broker's platform and we see that it has a gamma of 0.07. Fairly high. We can tell that this is probably an at the money with not a lot of time to go. That's why this gamma is fairly big relative to this delta. But now we're going to say that the stock rises $1 from 100 to 101. As we saw before, the call would rise from 229 to 283. So how can we get a better approximation? Well, we're going to use our delta like we did before, 0.51, but we're going to take gamma, 0.07, divided by 2 is 0.035, right there. So we're just taking delta plus this number divided by 2. So we take 0.51 plus 0.035, we get 0.545. See, now that's a little bigger than our 51 delta. And so this is going to give us a better approximation. So now we're going to take our option price of $2.29, we're going to add 54.5 cents to it. See, in the first example, we added 51 cents to it. Now we're trying to account for gamma. So if we do that, we get 2.835, almost $2.84. So now we've got a new stock price that we've projected. I can say I would expect that my option will move from $2.29 to about $2.84, and I look at the percentage change there, and it's 23.8%. Now in the first example, if you remember, we came up with 23.6. So you can see that we were a little bit shy. Now we're coming up pretty much dead on. And that's because we took the extra time to account for gamma. But you have to say, is this really necessary? If you're just trying to get a basic idea by how much your options price is going to move in percentage terms for a relatively quick $1 change in the stock's price, I would just take delta divided by your options price. But if you want to get a little more accurate, then you're going to have to take half of gamma and add it to delta. All right, so those are some of the calculations you can use for a $1 change. What about a 1% change? So once again, if the stock is 100, it's the same difference. It's a $1 move. But if it's a $500 stock, a $1 move is going to take it to 501, but a 1% change is going to take it to 505. And that's a very big difference. And so to calculate this, and I've talked about this in a previous video if you want to find more details, we need to use a calculation or a concept called elasticity. This comes up a lot in beta weighting and options portfolio. But elasticity does exactly what we're trying to figure out. It's telling us by how much our options price will move in percentages for a 1% change in the stock's price, not a $1 change in the stock's price. And the way that we're going to find the elasticity, we take the stock price times the delta and divide it by the options price. And again, the definition of elasticity is that it shows the percent change in your options price for a 1% change in the stock's price. Okay, so I know those can be a little confusing, so let's jump over to barchart.com, pull up a pricing model, and do a couple of examples. So now we're into a pricing model over at barchart.com, and I'm going to use a $300 stock price, just so we don't have a confusion between a $1 move and a 1% move for a $100 stock. So we're going to use an underlying stock price of 300, strike of 300, 30 days to expiration, risk-free interest rate of 0. I'll give it a volatility of 25% and no dividends. Now the model tells us that the option would be worth $8.58. So let's start with the first example that we did. We're trying to figure out if the stock makes a $1 move relatively quickly, by what percent is my option price going to move, this $8.58 right here? Well, let's make it very simple. Take our delta, which is 0.51. Remember, an at-the-money option is always going to be roughly a half. So all we have to do is to take 0.51 divided by 8.58. That's going to give us our new projected price. So let's bring up a calculator and do it. We'll do 0.514 divided by 8.58. 8.58 equals, it should increase by about 6%. 0.059, pretty close to 6%. So let's try it. So now let's take $9.10 divided by 8.58, and we get, look at that, 6%, or a multiple of 1.06. It just means that our options price has increased by 6%. All right, let's take this back to an at-the-money option, and I'm going to, and just for this example, I'm going to knock down the number of days so we get a lot of gamma in here. All right, so now I've got delta still about 0.51 roughly, but look at the gamma is 0.045. So if we want to figure out what our new options price will be, and we want a little more accurate reading, we need to account for gamma. So notice if I just take delta, let's call that 0.50 or 0.51, we should get an options price of 4. But if I make this 301, see, we're off by a little bit, and that's because of gamma. So if we come back to 300, now let's take half of gamma and add it to our delta. So half of gamma is 0.045 divided by 2, about 0.0225. We're going to add it to 0.505, 0.505, and that's going to give us, really, let's call it an effective delta of 0.5275. See, that's a little bit bigger than 0.505, and that's going to give us a little better approximation. So if I use this as my delta and add it to the current options price of 350, we get 4.027, or much closer to 4.03. But again, you have to say, it's a lot of effort. Is it really worth it for the little bit of extra precision that you get? In most cases, no. However, what if we wanted to say that the stock made a $3 move? Well, now we have to definitely account for gamma. So let's do that. Let's say that we want to know if the stock rises from 300 to 303. Well, that's a $3 move. Okay, so let's take a $3 move squared is 9. We're assuming the stock's going to move 3 points. We square it, that gives us 9. Squaring it just means 3 times 3. So at a minimum, I know I'm going to gain, let's call this 0.505 times 3. Right? We're picking up 50 deltas times a $3 change in the stock's price. So I know at a minimum, I'm going to pick up $1.51. But I need to add some gamma to it. This is definitely going to understate it. By how much? Well, let's remember $1.51. Let's take our gamma, 0.045 divided by 2 equals 0.0225. Multiply it by 9. That's the change in the stock price squared, is 0.2025. And I need to add that back to my $1.51 from delta. So I would expect that my option's going to pick up about $1.71, a little bit more. So if we add it to the current price of $3.50 plus 3.5, we should get about $5.21 or $5.22. So let's try it and see if it works. Let's make this 303, and this number should become about $5.21. So let's do 303, and there we go. Pretty darn close. So again, this method, when you start incorporating gamma, doesn't just work for that next small move. We can use much larger changes. So this is a nice way if you have, let's say, in the pre-market, and you see that your stock is up $3 or $4 or $5, and maybe it's close to expiration where you've got a lot of gamma, and you're trying to project to figure out what that option is going to be worth on the opening bell. Because if you wait for the opening bell, and by that time you're trying to make your calculations or decisions, it might be too late. You want to get all of this ironed out ahead of time. Okay, and then finally, our last calculation was for a percentage change in the stock's price. And what did we say the formula was there? So if we assume that the stock is going to make a 1% move, that would be from 300 to 303. Okay, so let's take the 300 stock price times the delta, 0.505, times 0.505, and then we divide by the options price of 3.50. 3.5 equals. So that's telling us it's a 43% increase we will see in our options price for a 1% increase in the stock's price, meaning in this case if the stock rises to 303. So remember 43%, let's see if it works out. So remember we started with an options price of 350. Let's change the stock price to 303. We get 522. So there's our expected percentage change if we take 5.22 divided by 3.5, comes up to about 49%. Now again, that's because we've got quite a bit of gamma, but that's the idea behind elasticity. If the underlying stock makes a 1% move, what percent would you expect your options price to move? Just take the stock price times your delta and divide it by the options price. So remember, the calculations aren't super important. You can always jot those down or run this into a pricing model to get your answers. The main thing to understand is that as things change in the market, everything changes with your options. Don't assume that your deltas and your gammas and everything else stay the same, because at a minimum, time's going to pass. And if you don't know how your options prices are going to behave, then you're guessing instead of trading. And for anyone who'd like to learn more about the arts and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a candlesticks and technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.